Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of October the 10th, 2016. Now to get started this week we're going to begin where we always do with the US dollar index. Now we're coming off a relatively strong non-farm payroll number. Now they're saying that we missed expectations. That's true. But in my view, overall, the number was actually fairly strong when we look at it on a moving average basis over several months. The jobs number was still a decent report, and I think that the market will view that as US dollar positive. Now, when we look at our critical vantage point levels here, we can see that we have had a fresh triple EMA cross prior to the non-farm payroll coming out. Now, this is again indicative of the fact that in most cases the market is working in a better number. Now, when I look at this, our Brexit high here, we've got a lot of volatility in the UK this week, but again, we're trying to push above this area. Now, our predicted short, medium, and long-term differences, our neural index, everything looks quite good here, and our predicted MACD looks excellent. The predicted RSI, however, we have a potential problem here. Now, in a lot of cases, when we've hit this level up here, up and around this 80, between 70 and 80 mark, basically the dollar is sold off. But in this particular case, I think the dollar has a better chance of advancing. Now, I don't think we're going to get a November rate hike, but I do see that December is very, very likely. So what we want to look at very closely here is our key vantage point 18-day predicted EMA, which is coming in at 95.81. We are firmly closing above that, and we're actually also closing above this Brexit swing high right here that's coming in around that 96.80 mark. So what we want to look at going forward here is, again, looking for the market to hold above this key vantage point level, but also looking to hold above this 96.60, 96.70. You can see we're closing right on this level right here, and that is the swing high from the Brexit. So again, you know, it does still look pretty positive for the dollar. However, it's not looking quite so good for the equity markets. Now, of course, when we talk about Fed rate hikes, the equities immediately start to sell off. On that, we've got a pretty tight channel here going in here. I just outlined this whole channel area here. Only a sustained break, guys, of the 2200 mark will actually take the pressure off the downside on the equity markets. We can see the Vantage Point indicators are all rolling over to the short side. Our predicted MACD unable to break above the zero line, and our predicted RSI now losing the 50. This suggests that we're going to come back down once again and check this and at least test this swing high from the Brexit. Now again, the equity markets made a big move down, they made a big move up, but then they did make a substantial move higher. They came back and tested this exact area of this breakout point, and they've moved higher, but they're not making any new highs here, guys. So this is telling me that in all likelihood, you know, we're closing below that critical vantage point 18-day predicted EMA at 21.5190. We're closing at 21.46. So at the very least, guys, I would be looking for a retest down of this 2100 level. We can reassess at that time. But again, in my opinion, that payroll number is supportive of the dollar, and more importantly, it's supportive of a potential Fed rate hike. Now, we can also assess here that the global equity markets are reacting to that payroll number. We can see the DAX is selling off, the Nikkei is selling off, but the Nikkei is still holding on to some gains based around that yen strength or yen weakness, So we'll see if this goes forward next week, but right now I would say that the global equity markets are likely going to come under some fire next week. Now, with crude oil, our key level now, Vantage Point level 47.42. They've got a bit of a bump here on the OPEC, which has helped boost it up, but not a lot going on here with oil. You can see we've got a swing high right here around the 50 area. We couldn't close above that for the week. We've closed at 40.81. The key Vantage Point level at 47.42. Nice move on the triple EMA cross. But again, this is based on OPEC. This is not based on real demand here, guys. So I think that oil is still going to remain very limited. Case in point here, we can see the Vantage Point medium-term predicted difference crossing over the long-term predicted difference, basically telling me that the medium-term trend against the longer-term trend is starting to weaken. And that would make sense in this particular case. Because again, the move up in oil was not based around demand issues or supply issues per se. It was based around what OPEC is saying. So they're just talking up the price of oil, trying to get it to go higher. But every time somebody tries to artificially move the price up, it never holds. Now, when we look at gold here, again, I've talked about gold here over the last several months. I don't see gold getting much relief here. The bulk of the gains on gold in 2016 have come off of the Brexit here. We've had a big move up here. Now, of course, we've got more volatility looking at the British pound. But again, when we look at that stronger payroll number, we can see that gold actually, the signal from VantagePoint on gold actually told us to start shorting this actually almost 2 weeks ago, long before that non-farm payroll ever came out here, guys. And this is the advantage of doing advanced intermarket technical analysis, is that we're usually ahead of the game. So when we look at a signal like this, it's indisputable that, and I've talked about this one last week, that I felt that we are going to keep going lower on gold as the Fed starts gearing up for another rate hike. So money pouring out of gold. But what's interesting here is this swing low from this Brexit breakout point at 1260. We've closed below that at 1248.90. So this tells me that there could be a bigger bearish move coming in gold, and I would absolutely support that, because again, gold is basically just a flight to safety. Saying there's supply or demand issues with gold is very, very difficult. Essentially, we've all heard the somewhat ridiculous rhetoric over the last few years of gold to 5,000, gold to 3,000. It got to 1,800 and it just crashed. So again, when the Fed or the FOMC is in a rate hike cycle, then gold is not your friend. Gold is your worst enemy. So again, I think that we could see a bit of a dead cat bounce here around the 1260, back up to the key vantage point, potentially back up to this key vantage point level here around the 1300 mark, but only a sustained break above 1300 will actually take the pressure off the downside to gold going forward. Now, as we come into our main currency pairs here, again, these are ones we want to really look at closely. The Euro-US currency, we're in a fairly tight range here, guys. We've got 111.95. We're closing 111.99, struggling, and that was after a big reversal back up. So in most cases, what happens after the non-farm payroll? Whatever happened, whatever the euro did on the Friday, it does the exact opposite on the Monday and the Tuesday of next week. So we've got a very mixed signal here, but the predicted MACD is telling us we are probably going lower after a small corrective move on the dollar index. Once the dollar index makes its correction and starts moving back up, the Euro-US is likely going to come under significant pressure, but we still remain trapped in the bigger, broader Brexit range, which is between 114.50 and 109.30. So at this particular time, I would look for a move potentially back into that 109.30 area in the days ahead. But again, this pair will remain very choppy. Now, when we look at US Swiss franc, which is the Euro-US counterpart, one goes up, one goes down. So if Euro-US goes down, US Swiss franc will go higher. Now, with my own direct clients, we have been strong buyers of US Swiss franc for basically months. 97.43, we can see we've closed the week at 97.73, above all three of the key vantage point predicted moving averages, struggling a little bit on the 3-day predicted moving average, but not a big deal. The position of the predicted short, medium, and long-term differences are absolutely in trend-ready levels here, guys. That's what we want to look for. Now, what I mean specifically by trend-ready levels here is we look at our predicted short, medium, and long-term differences. They are all sitting basically just around the 30, all positive 30 or above. That's telling me we've got a trending move coming here. Our predicted MACD is in supporting that. Our predicted RSI, again, struggling on that 60 mark. We're looking for some momentum to build around that 60 level in the market, and I believe we will get that in the days ahead. But again, for now, we're looking at still buying while above 97.43. I do anticipate a whipsaw move on probably Monday, Tuesday, Wednesday of next week, where the US Swiss franc could crash lower briefly, but we would be using that as a buying opportunity. Now, as we look at the British pound US dollar, I'm going to tell you guys here on Trader Planet what I've told my own direct clients is we want to stay clear of this thing. Massive flash crash on, I believe it was Thursday night. And again, This is all based around now the Brexit talks starting in March. Again, in my respectful opinion, the Brexit is a good thing, not a bad thing. The market, once the adults come back in and realize this, then the British pound will stabilize. But right now, this is a pair to be very, very cautious of. So our key vantage point level here now comes in at 128.94. We've closed at 124.32. 400 pips away from the Vantage Point 18-day predicted moving average, so I would not get too excited about shorts on this one. I think that the move lower was somewhat ridiculous. It's grossly overshot the mark, and I would look for actually a buying opportunity in the days and weeks ahead on this particular pair. But for now, my advice would be to stay clear when we see this kind of volatility. Now, as we come into the dollar-yen pair, what's interesting about the dollar-yen is that if the global equity markets sell off, then we're likely to see the dollar-yen sell off. Now, the first sign that I've seen of potentially of this is we can see that we have a swing high around 104.24. We've come back up, hit that level, and then had a massive sell-off here. Now, we could recover. Our key vantage point level comes in at 102.04. We've closed at 102.90, well above that 18-day predicted moving average. So there is still some hopes for longs here, guys. But to be perfectly clear, we really need to break through this point right here. A sustained break of 104.25. We should see a bigger move, but we can see the medium-term predicted difference crossing over the long-term predicted difference. It's warning us that this trend is not strong to the upside. It's not strong at all. So we want to keep this in mind, bring in the additional indicators, and be very cautious of this pair. And again, when I bring in the additional indicators from VantagePoint, they do warn me here. We can see our predicted RSI. This is absolutely a concern. When we combine this with our swing high right here, we can see we have a very similar signal, and this is what we should be watching for. So as the Vantage Point predicted RSI turns lower, we can see we match that to a swing high. We've got a problem. We absolutely have a problem here. Now, even on a stronger US dollar, that doesn't mean the dollar will make gains against the Japanese yen if the global equity markets, begin to sell off. So try and keep this in mind. Watch the 102.04 area very closely. I would anticipate we will test this area by Wednesday of this week. If this area holds, it represents a buying opportunity, but if it doesn't, then we are probably going back into the sub 100 level. So be very cautious again with this pair. Now, as we come into our main commodity currencies here, one of my favorites, of course, is US Canada. This is a fantastic call from VantagePoint here on the triple EMA cross when we match it to that Brexit high. So you can see that we've had a lot of chop around this area here, around this Brexit high, but this time we've come down, we've pushed higher. Now, the Canadian dollar immediately strengthened based on the Canadian unemployment report, but once we look closer at that unemployment report from Canada, we realize that the 67,000 jobs that were created, the bulk of those jobs were just part-time jobs. They were not full-time jobs. So again, not a big bonus here for the Canadian dollar. We've got oil prices that are basically being artificially inflated, which are unlikely to hold on. Crude oil is unlikely to hold on to its gains, all of which will put pressure on the Canadian dollar. Now, we can see our predicted short, medium, and long-term differences all pointing higher. Neural index is in support. Predicted MACD looks excellent, and the predicted RSI is again continuing to advance, but moving to some degree towards overbought at 71.3. So for the coming week ahead, our key level here, is the 131.50 area here. We've closed well above that 132.95. Very, very strong close here. So when we look at the 131.50 area, as long as we stay above 131.50 next week, guys, we have a real shot here in the days, weeks, if not months ahead of moving back towards that 138, 140 area. Now, a lot of people will say, oh, it can't go that much higher. Guys, of course it can. When we look at this currency from 1 year ago, we were considerably higher. We were at 146. Okay, so whenever somebody says, oh, it's overbought, blah, 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 just be careful of this. Okay, we can see that we've hit a high of 145, 146. We've come down, but we're now moving sideways again in the bigger, broader uptrend. And now we're breaking through this. When we look at it on a year-over-year basis, you can see that we're breaking that Brexit channel. This is all pointing to a much bigger move to the upside. Now, that may happen next week, that may not happen next week. The idea here is to remain focused on these levels and understand where they are. So when we look at the key vantage point level, once again, 131.50, I will anticipate that area will hold next week, and we should be strong buyers on a dip. Now, the same thing would apply to Aussie US. Aussie US, I've talked about this over the last several weeks here, this Brexit area here, that the Aussie dollar is really struggling with. Now, we do have a mixed bag here between the short, medium, and long-term predicted differences. They haven't rolled over to a trend shift yet, but they are certainly warming up to the idea. 76.21 next week is the area to watch here, guys. As long as we can stay below this area, then we should be coming back down below the 175, below the 75 area. This would also be assisted by lower gold prices and lower equity prices. If those two global equity markets continue to sell off, the gold and precious metals, they all start to move lower based around the US dollar strength, then the Aussie dollar is going to move lower, and I think right now that's a high probability. But the indicators are just not there yet. They are certainly, again, warming up to this idea. We've had a very bearish close, 75.77 here. So again, as long as we can hold below 76.21, I'm going to go as high as, say, 76.50, 76.80, as long as we don't get a couple of days in a row closing above 76.50, 76.80, then all eyes are on the downside here, guys. So if that's the particular case, then once again, we could even be looking by year end a retracement back into this 74, 73 area, which is very, very likely at this particular time. Now, as we come into our final currency pair, the New Zealand US dollar, I've also talked about this one repeatedly over the last several weeks, and the area to watch. We've got a very tight, very, very tight channel. Once again, I want to bring everybody's attention to the VantagePoint triple EMA cross that's taken place basically 6 days before this channel broke. They gave us a warning that that was going to happen. We've had retracements back to the 18-day predicted moving average, but ultimately when that triple EMA cross broke, we then broke through that all-important 72.50 area and then crashed down to where we are now at 71.60. So for next week, guys, 72.47, the VantagePoint 18-day predicted moving average. This is the area. As long as we hold below that area, we look good. Now, our indicators are definitely mixed here. Our predicted short, medium, and long-term predicted difference, is moving down. Our short-term predicted difference is advancing higher. But the predicted MACD crossing the zero line, that's a big one, guys. That's quite big. Now, once again, there's no guarantees in trading. Who knows what they're going to hit us with over the next couple of days. But for now, it does look like we have the chance to move back into the 70-cent mark or below. So when we look at this, and we combine the indicators, we're looking for the short, medium, and long-term strength to continue to advance to the downside here. Right now, again, the 72.47 area, we're about 100 pips off that, 80 pips off that area. We're looking for that area to hold, so any retracement to that area at this particular time is a very reasonable area to reset those short positions.